Welcome back to the Compassionate Capitalist Show. Today, we are going to dig into different types of commercial financing for businesses and understanding some approaches to that my guest Paul Neal has. His company is Vantage Point Commercial Capital, and he brings a really unique perspective to it because of his experience as an entrepreneur, and then now on the financing side of it. He's the founder and principal funding strategist at Vantage Point, and it's a firm that really focuses on helping entrepreneurs and real estate investors, but primarily those businesses that are seeking to own the buildings that they're in. And we're going to talk about why, kind of leading into where we're going with some of the direction that I believe business is going to take. We're going to get into that in this conversation because of some of the new stimulus programs, as well as some of the incentives for manufacturing in the United States. That's going to create an opportunity for a number of businesses that may be outsourcing their manufacturing someplace else to now bring that in-house and buy the buildings and the equipment to be able to do that. And so that we're going to dig into some of that. And he took the road less traveled. So this is something we're going to wait till the end. So you have to wait to the end to really understand this story. But he was in engineering in college, but chose the entrepreneurial path instead of the traditional engineering path. So we're going to really, I can't wait to hear that part of the story and his journey as an entrepreneur, the pluses and minuses and the ups and downs of doing that. We just shared a little bit of commonality about the Great Recession and how some of the financial institutions really had a negative impact on that. And really to where he is right now is sitting on this side of the table, provided financing in these creative ways. And we have a common belief that entrepreneurism is like the heartbeat of America. To me, it's in the DNA. And so we're going to talk about that, his journey as part of that, because that's a common feeling that he has near the end. So stay in on that. So let me say, hey, welcome, Paul. Thank you so much for being on the Compassionate Capitalist Show.
Hey, Karen, thanks for having me on. I'm really excited about having a conversation with you today. It's going to be great.
Okay, great. So let's start. We're going to start out with a primer real quick, because there's different types of capital that is available to entrepreneurs. And it's important for the investors that are listening to understand this, because every business, and this was something that I learned when I first left IBM, and I went in and I started understanding about angel capital and venture capital, and there was all kinds of financing that I was not familiar with at all. You always hear about a bank loan or SBA loan, but these other kinds of financing that you get. And at any point during a growth of a company, they will have both. If they're a high scale company with equity investors, they will also have debt. Okay, debt builds the gap. And when it comes to investor capital, there are things you want to spend investor money on and things you want to get financing on. Like, for example, you should not get investor financing, use investor money to buy equipment when there's readily available asset-based lending for buying equipment, or for buying land, for example, or for buying the building, the kinds of stuff that Paul works on. But then there's other stuff that's sort of interim. So we're going to kind of break down the different types of capital that's out there, the different types of debt that's out there as a primer before we dig into, a little bit more about how to use that. Okay. So let's talk about cash flow lending and working capital, purchase orders, accounts receivable financing, things like that. Because the reason why Paul is so great for this conversation is that their Vantage Point Commercial is really sort of like your financing coach when it comes to what kind of capital do you need at different points of your business, and the most efficient use of capital when you're building and scaling your company. That's why we're going to cover this kind of stuff. So even if it's not financing, like I talk about that all the time, but I would go to somebody like Paul and their company and say, hey, I've got this company I'm working on, their equity side of stuff. Help them understand and get access to some of these other sources of capital and use it that way, because he's got like real insights that are real time right now because he lives it and breathes it every day. So with that, let's talk about that short term. I call it sort of like revolving types of capital because it's replaceable, but it also can be a slippery slope if you don't use it properly when it comes to getting that kind of debt on your book. So the cash flow lending kinds of stuff and working capital. So say let's do a hypothetical. Somebody is and I had a company like this once. They've been selling business, they're selling their widgets. All of a sudden they get a giant order for a retail order that's more business than they've done the whole prior year. There's no way they're going to a bank because a bank is going to based on current books. They've got to get creative on that. They need to be able to get financing from a China manufacturer, let's say. They need to get a letter of credit to be able to start that manufacturing, and they need to be able to manage their cash flow as they're waiting for that big giant retailer to pay them. What are some of their options, Paul?
Yeah, I mean, you hit a problem, a major problem right on the head, particularly for fast growing companies like that would get a large contract. It's funny, we always hope and pray for business, and sometimes when it shows up like that, then you're really hoping and praying, how am I going to pull this off?
Yeah.
Because to execute on an order like that could be a game changer and maybe elevate your business to the next level takes a lot of capital. I mean, we talk about it's funny, all the conversations I have, and I'm sure you have them with Karen as well, with your clients and people that, I talk about the 3 C's of lending: credit, collateral, and cash flow. That most business owners don't realize how much cash a growing business consumes, right? So
Yeah.
if your business is kind of lumbering along and things are sort of copacetic there, or maybe declining, which is generally what happens if you're kind of lumbering along, your cash requirements aren't that great, right? But if you're growing, so even without the big order, you've got to source your inventory to, raw materials. You've got to have space to actually, if you're in manufacturing, let's say, to put this together, you may need employees, you may need to bring in, skilled labor, machinery, things like that to actually put something like this together. And that takes money up front before the first dollar of revenue comes in, right? And so maybe even, you might be 90 days just getting that together before you can even, ship your first, product out the door. And then some companies, on the receivable side, the accounts payable, they'll take advantage of businesses. I could name a few big ones.
Yeah.
Walmart being one, for instance, right? That we all love Walmart, but boy, if you're a business owner and a supplier to Walmart, you win that contract, you think you hit the lottery until you find out the terms that they put you on.
They'll do like 90 days, right? After it sells.
After.
So it's after it sells. So the QR code goes through the thing and then they'll pay you 90 days later.
That's right. That's right. And you're really selling on consignment to Walmart. And then every year they tighten the screws a little bit more until you're, you become a one-shop pony, and it's a really scary place to be. But anyway, hey, I love Walmart. I shop there, right? But from an entrepreneur standpoint, so yeah, financing, that sort of thing, is tricky. The banks are going to say no all day long. You don't have the cash flow. So there is alternative finance. A lot of people think that there's such a big push. Everything is online today, right? Everything is we're gonna get the we're gonna push the easy button, a simple form and a button, and all of a sudden I'll have this approval in my my email inbox in 5 minutes, and I'll get all this money. And there's a price to be paid for that, right? The whole fintech industry, I kind of laugh about it because it's convenient, but man, alive, I mean, it's like legalized loan sharking in so many cases for people.
Oh, I know.
And it's like you get on the easy credit crack, I call it, and then it's hard to get off that merry-go-round. You see, it's like the people that the unfortunate people that are, go to these check cashing places with their paycheck. And it's like, man, once you get on that, it's like, how in the world do you get off of that?
Yeah.
And I don't know the answer, in that standpoint. I feel for them for sure. But there are methodologies and ways that you can finance that without going into debt. And that's what I like. I mean, I'm not a huge advocate of debt unless it makes sense. And that debt is going to position you to have success now or into the future. And it's well thought out. It's not just sort of a knee jerk and we jump in.
Yeah.
You know, in this scenario, like we talk about, there are options like a purchase order financing. And, you know, so if you you have a client like that places a major order, and we see it, sometimes it's $1 million, $2, $3 million order that comes in. You're like, oh my gosh, you know? So, you know, there are ways to get the money advanced up front based upon the strength of that purchase order. So you can go ahead and make the deposit payments and things that you need with the manufacturers, the resources, the things that you need to go ahead and put the production in place, to, you know, to ultimately fund that growth. And the great thing is that it's not a debt. Now you're gonna pay there, you know, there's going to be a premium on that. But again, it's a project specific kind of a, you know, funding. You're not, you know, you're not tying up your firstborn or your lastborn for that matter, you know.
Yeah.
And and it really can position you to win in the future, because on, you know, if you're able to pull something like this off, I mean, yes, there's a cost for the financing, but there's a bigger opportunity cost in many cases of not being able to execute on that opportunity. Because, hey, once you do that, now you've got success, you've got a great story. You're able now to leverage that to get more consistent, perhaps large orders, and then the profit that you can realize from that can put you in a position where you may not need that kind of financing going
Right.
forward.
So a couple of things, caveats I'd throw in there on that is that all these alternative financing lenders that are not your traditional bank lenders, they always want to know they're going to be able to get paid, right? That the reason why they do it, so they do it on the credit worthiness of whoever's buying it. So to factor that purchase order, or that what ultimately the invoice is going to come out of that then pays, that is in place. The purchase order financer wants to know that that's in place so they can get paid, right? The manufacturer wants to know that you've got the financing so that they can get paid when they're done manufacturing and ready to ship it. So they're all kind of linked, and they all get a little piece of the pie on that, and that they take out before they give you the cash on that. But you know, it's really important for entrepreneurs to look at the contract with those purchasers, because not only can it be this extension, it may be worth your while to offer a discount that says, I know the terms say 90 days, but if you pay me in 45 days, I'm going to give you 3% off, because that saves you. You're going to end up paying that anyway in interest on your debt, but that gets you that money that is yours to you know, use for payroll and your own kind of stuff. And you want to make sure you have sufficient margins, because to be able to pay for all of this and carry that debt, because in 90 days, ideally, if you're growing, you're going to be getting other purchase orders that you're going to have to buy product for. You just don't want to sit for 90 days. So it starts to accumulate. That's where it can become, unless you've got enough margin and that money that's coming in to pay against that is enough extra to give you your 25% down or whatever the manufacturer might require, so you can start to get unhooked from that. So that's one thing I want to make sure. And the other thing I want to make sure our listeners know, look at those terms of what the return policy is, because sometimes, like this particular company I was talking about, it was with one of those Costco kind of a companies, right?
Yeah.
And they have a very liberal policy for taking things back. So this was a summer kind of vacation type of a product, and 90% of the products came back, not for a defect, but just because people didn't want, and then they sent it back to the company, right, and the company had to take it back, but now it's a used product. Yeah. And they still had to pay the debt on it. So if that's in there, and there are a big company like that you feel necessary to do business, go get insurance against that, because the lender got paid. Right. But there's companies that offer insurance against those kind of things. So those are all, you got to think about this and think all the way through before you just take that easy money. Right.
That's
okay.
Absolutely true.
So,
I was going to say, you're absolutely right. And Caesar's always going to get his. So yeah, you better make sure you're watching out for yourself. And, you know, that's one of the things that we try to do, Karen, is like we talk about partner, we look at it as a strategic relationship with our clients for the long term, and we'll get in my story later, but I've been an entrepreneur my entire life, and I've had some great wins and some great losses. And I've seen it, and I know the heartache. And so we have a great heart for business owners, and what it takes. And you talk about the cash flow thing, and and just even a non-debt solution. You talked about getting that accounts receivable moved up from 90 to 45 days. One of the things that we teach, and we don't make any money on this, but yeah, get as aggressive as you can on accounts receivable, and going for deposits with customers and things that you can do to help improve your cash flow. I mean, Michael Dell was like the guy who sort of, just turned the industry around with computers when he came out, when he said, I'm collecting full payment up front before I even start a computer,
Yeah.
So what a way to go. And I'm not saying we can all do that, but I've seen so many companies that they're lackadaisical in that, and just a simple system or process to add, to maybe take somebody on your staff to even, hey, when that invoice goes out, to follow up with a phone call, say, did you get that
Yeah.
invoice? Don't just assume they got it, and then 2 weeks out, hey, did you get that? And then, the early payment terms, that sort of thing. And
Yeah.
is a way to certainly improve cash flow.
I, even though I'd gotten my MBA, all that kind of stuff, they don't teach that kind of stuff in school, right? But when I was with IBM, and we were, we at the division I was in was financing the for PC resellers, the equipment that they had on their floors, or like with the schools that would be buying it for computer, whatever, right? Be the things. And IBM did that. IBM, if you paid 5 days earlier than it was due, they would give you like 3%, right? Big old IBM. And the thing that they had a whole team of people that all they did was make sure that the invoice that went out matched what the purchase order did, because sometimes these big companies can't pay it if the invoice doesn't have the
Yes.
right details on it.
Exactly.
And and then you'll spend weeks trying to fix it. So do that up front. Those kind of things, those little paperwork things, those are the things that it's the devil's in the details. And that really does make a difference. So I want to move into kind of your core stuff, which is commercial financing for buying a building. The scenario I did at the beginning, because I think particularly chip manufacturers, things that have chips, there's going to be a lot of this coming in into the country of manufacturing here and bringing back our manufacturing. We had a wave of this in the 2000s because of some of the incentives. They got a tax write-off if they started manufacturing here, things like that. And I think we're bringing some of that back and this is where equipment financing, things like that, all of that kind of stuff comes into play. We did, because we saw it during the supply chain crisis that we had earlier this year. It was because we were waiting for these boats to come in from overseas. And there's really no reason why with robotics and with all of this kind of stuff, it doesn't need to be labor intensive anymore. You can be manufacturing here. And in fact, you see all of these foreign car manufacturers that now are building plants in the United States for the supply chain issue to avoid that. So talk about how that might work with your credit, collateral, cash flow, your three legs of the lending stool when it comes to a company that wants to now bring manufacturing into the United States, or some of these kinds of things that are sort of traditional kinds of lending kinds of activities.
Yeah, well, gosh, you're open Pandora's box there when you talk about the deglobalization of the world, and how we're actually, the United States is in a really super position for that. We went globalization because we could do distribution of cost and labor, but as labor costs go up, and as the other issues that were obviously brought to bear here in the last couple of years of supply chain and technology today, we have such a wealth of resources here in the United States of intelligent people, just resources. Land, we have land, we have, I mean, farming, we're basically self-sufficient, and so the onshoring back of manufacturing is huge. And I think we haven't seen anything yet by any stretch, but so there are huge opportunities there. And I mean, you could start with a huge manufacturer coming in, and you see the chip manufacturers, those are kind of long-term plays. But at the end of the day, whether you are a huge manufacturer or you want to get into that space, or you're a local landscape company that, you've built this business in the last 2, 3, 4 years and you're paying rent. You're like, man, why am I paying rent to someone else when I can own this building? There's a lot of talk out there in the world about investment real estate and, let's buy single family homes, multifamily, properties and that sort of thing. And, Robert Kiyosaki, I know you're a fan of his. He's big into that, and I'm loving. I'm an advocate. I'm an investor. I have that as well. But a lot of people don't think, even at the lower end, professionals, they don't think, hey, maybe I should buy the building I'm in. I mean, if you have there's this flight from like the office space, corporate America, where, people are working from home, which I get. I probably wouldn't just buy an office building, but there are a lot of businesses out there that require a physical space. And, from retail to like we said, the landscape, your veterinarians, for instance, and dentists, we work with these people all the
Yeah.
time where they think, traditionally they go to the bank says you need 20% down, you need all these things. We want your firstborn, we want covenants, we want all your deposits. We want to basically own you as this relationship. And it's hard to do, but the benefits are huge in the long run. For instance, a friend of mine, she's an OBGYN, and she bought her building about 12 years ago, and she's now approaching retirement. The medical space, that those smaller practices are all getting gobbled up, right? So she sold her practice 2 years ago for a nice sum of money, but she retained ownership of the building. The building's now paid off. She's going to work a few more years, but this megalithic, medical group now pays rent $9,000 or $10,000 a month of free cash flow to her, just for the building.
Yeah.
So, it's like, wow. And, a lot of our clients will lease out, a substantial part of the space. So that helps defer costs. You get depreciation. And I tell you the other thing, when you own your own building, whether it's on a small scale or a large scale, you're adding value to your business.
Yeah.
Substantial value to your business when if you choose to sell it one day, if that's your option, because it's not all blue sky now. We have real tangible asset, plus cash flow, plus a customer base. And gosh, one of the industries right now that's so, like, I see it all the time. I have clients and friends that are in the car wash business, for instance. You see them going up on every corner. It's really aggressive. I had a friend just sold three car washes, and they bought them with the idea of, we want to own the land, we want to own the real estate. The cash flow is just going to pay for the business, right? But ultimately, we sell the real estate, and they cashed out for a multiple 8 figures on these things in a very short period of time because of the location, the real estate, the cash flow, and things like that. So, if you're an entrepreneur, that's something you really, really should consider. And the impediments, the traditional impediments of, I have to come up with all this money down and whatnot, are definitely, they're not necessarily an impediment.
Yeah.
We talk about the 3 C's, collateral, cash flow, and credit. That's the collateral piece. And gosh, we even, if the credit and cash flow is right, then we've even done deals with a 0% equity injection. So it just depends on the situation and scenario of someone. And if they're going to be in a business for a long term, or that business, maybe their goal is to sell, but that business would benefit by being in a community for a long period of time, then it's definitely something to consider for sure.
So when somebody's looking at, because I know medical practices have traditionally been easy, relatively, it's not quite the easy button, right? But because there's a predictable cash flow associated with these medical practices, how is that different if somebody says, I want to buy a franchise that has a building, I want it that, and it's going to, require real estate, or I wanted, like in your example of the landscaping, or it's a non-traditional, say, CPA business, or something like a car wash. Like if I'm new, this is my side gig. right? I'm just putting this money in. Maybe I have a day job. Talk about the variables for something like that when the business itself doesn't, or the person borrowing the money doesn't have a history of cash flow with that business, but it should have good cash flow based on other metrics and things like that, how that might factor in.
Yeah, sure. That's a great question. So, a couple of scenarios come to mind. So, there are asset-based lending options that we have where we don't even consider cash flow on a property. Generally in a situation like that, there's a little more collateral required in terms of they need to have some money, some skin in the game. But on a business like we'll take franchising for instance. So franchising is somewhat predictable. So if someone's buying maybe they're starting a new franchise and that franchise requires real estate. Well, there's enough of a track record with the sort of the national franchise to kind of know, okay, we can run these projections. We know, what to expect. The only caveat there is we just want to really know and understand. Obviously, that franchise has vetted that franchise or potentially that, hey, we think they're going to be a good candidate. But in addition to that, we just want to know, hey, has that person had some modicum of success in their life, whether it's on the current, maybe they've been at IBM like you did for a number of years, or some position where that we feel like, hey, they could manage this. They could go in and operationally run this business. I mean, because that's the big risk, right? Because you have a model that's proven to work if you just execute the model. But so, if it's new, then you're like, well, what have you executed to this point in your life? And
Sure.
and credit would be important in that scenario because, if you're not bringing cash flow to the table, then credit's going to be important. And, you don't have to necessarily walk on water, but it has to be a demonstration of you can handle your money, that sort of thing.
Yeah.
So there are definitely ways. And, we do a lot of business acquisition and 90% of the underwriting for us is if a business has been running and operational, we're going to look at the cash flow of that business. Now, if it's a turnaround situation, again, so I've got a young guy, right? Entrepreneur. He's buying, he's in the popcorn business, believe it or not. And he's got these retail locations he buys are in tourist areas, and he's done really, really well. And so he's put systems in place. Okay. So he's learned how to build a business, not just have what I call an entrepreneurial job, right? Where he just goes in there and does everything.
Yeah.
So he's got a business that now he can duplicate because he's got successful systems. And so he's going after and approaching other little mom and pop sort of popcorn or popcorn related type businesses in different cities that he can now buy that aren't doing so well, but he's applying his skill set, his systems to turn those around. And there's a lot of opportunity for somebody like that to acquire and grow. And he's also getting the real estate. So he's building this whole portfolio. We talk about, diversified income streams and whatnot. So he's doing it through acquiring different businesses and different geographies and things
Sure.
like that.
Yeah. Interesting, interesting. So let's roll into kind of like we talked a little bit at the beginning about how a bank is very structured and limited. In they're not as flexible to be able to look at those three pillars and how they relate. Let's apply that to you mentioned about acquiring these other businesses, but what about when it comes time and you need to the younger generation needs to buy out the older generation, or partners, one's ready to retire and wants to sell their interest? How does that work with you providing small business loans for something like that, compared to like how a bank might not be as flexible to look at those kinds of things because there may be, the influence or the contribution that particular that leadership team has been providing. And what will that, do you look at how that might impact in the future, or do you look at the opportunity that they're going to be able to do now that these other people aren't involved in the business?
Yeah. Yeah. So all of that really, I mean, so if someone is buying out, we call it the graying of America, right? We're seeing the gray tidal wave, the silver wave, whatever. But, there's a lot of that. There was a lot of that in COVID, right? Because business owners were, faced with, hey, I've done pretty well. I'm getting a little older. Do I really want to ride this pony? And we're seeing it now too, because, some recession concerns. So do I want to dig through and do what I have to do to, continue to grind this out, or am I ready to kind of punch out? And so there's a lot of opportunities there. But, again, yeah, if somebody's buying a business and they've been part of it for a long time, that's a huge, huge thing because, they're in it. They know the culture. It's not nearly as disruptive if somebody's necessarily coming in from the outside. So that's important. You know, the thing about banks too and different lenders is what everyone has to know is that, you know, all lenders and investors are different, particularly in the commercial world, right? You can't just make an assumption that, we see this all the time. We have people come to us, they went to their local bank because that's what the guy does, right? I'm
Yeah,
busy running my business and I need a loan. So I go to the bank that I've been dealing with for,
from a
20
checking
years.
account, right?
They have all my money, we've run all this money through my account for all these years. And for whatever reason, that bank, whatever this particular guy he wants to do, it just doesn't fit into their portfolio. It's like they've got their soup of the month club, and this month, we don't really want that, and it's not that that they couldn't get funding. It's just that bank said no.
Right.
And so here I am, Joe Entrepreneur, and I get turned down from my bank. I might go to one more, but I'm busy running my business, right? And so who has time to ferret all this out? So they all have different sort of guidelines and overlays. You and I were talking about in the Great Recession how a lot of banks, we went through this. We have friends that have gone through this. There were banks were calling loans.
Yeah.
And loans that were perfectly good and performing, but the banks, they were saying, well, we just don't want this on our books anymore, and so we want you to get rid of this, refinance it, pay it off, do something. And it got really ugly. Um,
They
so
were
so they all
offsetting their losing mortgages, so they had to offset it on the small businesses out there, and just really spiraled our economy. But
they were, and so what everyone has to understand is they're not, banks aren't our friends really as entrepreneurs and business owners. If you walk on water and you don't need money, that they're a great place
yeah,
to go.
yeah,
They will take care of you. They love to have you. But as soon as their appetite changes, then you can easily go to persona non grata very quickly. They're focused on satisfying regulators first, shareholders number two, and the board of directors number three. And you happen to fall in there somewhere down the priority stack.
yeah.
So when you sign up with those guys, you sign up for covenants, you sign up for recourse, you sign up for a lot of things that we talk about reading the fine print on some of these contracts. Oh, OMG, right? If you read some of these lending contracts from the banks, it's like, oh, it's an unstable angina. So, so that it's really important where you go. And that's one of the key things is that we live and breathe this stuff. And so we want to know what your issues are, the idiosyncrasies. What's the hair, what's the skeleton in the closet that's gonna come out. It's gonna come out no matter who you talk
Sure.
to. So let's put that on the table now, and let's try to figure out, is there a solution that fits your particular needs now? Or maybe it's not now. Maybe now's a no, but maybe 6 months, a year, 12, 18 months, you can put a plan in place and
Right.
position yourself. Right. Because
Yeah.
I mean, if you're in business for 6 months and that's your goal, then then that's probably not a good thing. But
Yeah. I had a client one time. We had to do this 6 months because he'd been doing his taxes for the tax man,
yeah.
right, to minimize his tax burden, but
Mhm.
it impacted what looked like on paper his cash flow.
Yep.
And so he had to unravel that, and the way he was, handling his different LLCs underneath the thing, so that he could get to a point we could get financing to
Yep.
buy his building, because he looked like he had no cash flow. And
Right.
so, and when you get ready for selling a business, right, a lot of it's based on cash flow, your assets,
Oh yeah.
right, and your cash flow. So that might be part when you're buying out a partner, they value the business. You get a third party opinion on the value of the business on that, and whatever's negotiated, and then you look to see how you go about financing, and sometimes it's the business itself that becomes the source of securing that loan, right?
That's right. No, you're absolutely right. Sometimes you have to peel the onion back a few layers and put a plan in place. But this, right? If somebody's got a business that's successful, there's a way to do it.
Right.
The hardest thing for us is to take an unknown quantity, someone who doesn't have a demonstrated track record of success, and on those three, the three C's of credit, collateral, cash flow, they've got no demonstrated cash flow, and they've got an idea and a dream, and maybe no collateral. So that's something that we have a hard time with, but everybody does, you know. So you gotta pay your price one way or another. But if you've gotten to the point where you have a business that's, hey, it's profitable, you're doing well, whether the paper shows it or not, it's successful. There's a way to put it together to achieve your goals.
Yeah.
In finance.
So we have about 5 minutes left. I want to take a break real quick and say, everybody, if this is interesting, if you feel like you need to understand your options when it comes to financing, please go to vpc.capital, not your usual domain there. Vantage Point Commercial Capital is vpc.capital. Okay. So do that. And then let's get into this near and dear, why the entrepreneur is the hope of the world. We got about a little under 5 minutes left. Let's talk about that, and talk about why you had a dream when you went to college, engineering, and then then it's like entrepreneurs, and you stayed with it. So you've had the ups and downs of that. Why is it, Paul, that entrepreneur is the hope of the world, and why do you love being an entrepreneur?
All right. Well, there's a lot into that for 5 minutes. So I'll try to put it in there. So here's the thing. Entrepreneur, I think we're all sort of cut from the same mold. We're certainly different, but if you're an entrepreneur, you have a dream, you have something that you're aspiring to bigger than sort of where you are today. For me, it's about, freedom. That's what's always motivated me, freedom to do what I want to do, when I want to do it, where I want to do it, with whom I want to do it, and control. I'm kind of a control freak, right? And so my first job, when I was, even before I got to college, I didn't like someone telling me what to do. And so I came through school, studied engineering, actually worked in the field as a co-op student when I was in Virginia. So I got to work in engineering and then go back to school. And then I had took a job right after school. And I remember sitting in an 8x8 little cubicle. Actually, I think it was an office, but you had the hum of the fluorescent lights, and there were way too many people in this little room, and we were arguing for and I was not arguing. I was new. I was just kind of there like checking it out, right? They were all arguing about the color of these little rubber booties that went on the bottom of these $70,000 network analyzer devices that we were making. And back before the internet was, kind of there coming online. And I was like, I'm if I have to do this for 30 years, I'm going to slit my throat. Right. I'm like, no. So, I had the entrepreneurial bug, and it's a long story. I got connected up with my sister and brother-in-law had gotten in business and were doing well, and just kind of opened my eyes and hitched my wagon to them. And now I'm seven companies later, and it's been a great ride. But I will tell you that I think the entrepreneur is the hope of the world. And what I'm passionate about is because I think what we're facing today in the world, and I'm not getting political because it's not political, but I think we're facing the enemy of big. I think, here in this country, we have an opportunity to be an individual. And I think the world is trying to make us all victims. And when we're victims, then we're dependent, and we're no longer free. And you can see it everywhere you turn with, you got big media, big government, big tech, big business. I mean, big business did quite well during COVID, and even the big banks. And so they're all about sort of, aggregating the power and the money to the top of these megalithic, organizations. And when you do that, then we lose individual freedoms and ability to be who we want to be, who I think we're created to be. And by taking that back and not being a victim and being an entrepreneur, and just literally flying in the face of, everyone saying, well, don't do it because you're going to fail. And then, what's going to happen? You're going to lose your family and all that. To then when you eventually make it, God willing, they're all saying, oh, well, he was lucky because the interest rates were good, or, this or that. Those of us that fly in the face of that, and we grind it out, when we win, everyone wins. Our families win, our employees win, our communities win, because now we're positive influences, because you know what it takes to do it, right? You can't be a slug and be successful as an entrepreneur. You've got to grow as a person.
Yeah.
And you're not you're not a mean person. You're not a racist. You're not anything. You're like, man, I want these people to win because when they win, I win and we all win. It's sort of a natural thing. And so